Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, your weekly podcast on ETFs and more. Today we have Scott Crow, the CIO of Center Square, to talk to us about REIT investing in a rising rate environment. Many people are pretty skeptical of REITs in this sort of interest rate world, but Scott offers up a solid perspective and some market segments you want to watch if these trends continue. And don't forget to send us any topic ideas you have or things you want to hear about by reaching out to us at podcast@zacks.com, over on iTunes, or at my Twitter page at Eric Dutram as well. But stay tuned for my chat with Scott right after this. Okay, Scott, thanks for coming on today. So the Fed is on a rate hike path, and several more hikes are expected this year. Generally, people view this as bad news for higher dividend-paying securities out there. This includes utilities, staples, even REITs, and at least for REITs, you don't see it that way. Why is that?
Well, because what drives the performance of underlying real estate markets, and hence what drives the performance of REIT stocks over the longer term, is longer-term interest rates, not short-term interest rates. And that's for a very simple reason. Longer-term interest rates are the interest rates which basically set the borrowing rate at which people use to go and purchase real estate investments. So if long-term interest rates increase significantly in the absence of any expectation of better growth or inflation, that's bad news for real estate because borrowing costs have increased, but cash flow expectations haven't changed, and that leads to a lower price. So when you have the Fed raising interest rates as a real estate and REIT investor, the most important question is how is that affecting long-term interest rates? And if you have a look at the decision this week, it's a very good case in point. The Fed raised interest rates, 10-year bond yields fell 10 basis points, and REIT stocks went up, and they actually outperformed the S&P 500. So the danger is people take too much of a simplistic approach when they're thinking about interest rates. They have to figure out what interest rates are important, it's longer-term interest rates, and how they're going to behave relative to what the Fed's doing. But, as importantly, or probably more importantly, as it relates to what's happening in the broader economy.
So what kind of benchmarks should investors be looking at, if not, say, the 2 or 5 or 10 year? Is there a longer level where investors should be focusing their efforts if they're in the real estate investing world?
Yeah, so the average duration of debt that people put on a commercial real estate investment is probably around 7 years. So it's somewhere between 5 and 10. I mean, as practitioners in the space, we just focus on the 10 years. It's the simplest and easiest thing to look at. There is one other thing to look at here as well, which is credit spreads. The fact is that as a real estate investor, you don't borrow the 10-year government bond rate. You borrow the 10-year government bond rate, which is a base rate, plus a credit spread, which is the spread that is charged by the financial institution giving you the loan. So one of the interesting things that tends to happen as the economy improves and 10-year bond yields rise, commercial real estate values also increase. In fact, if you look at 30 years of data, there really is no single period where bond yields increasing by themselves has led to a decline in real estate values. And that's for two reasons. Higher interest rates on the long end of the curve almost always reflect better expectations around economic growth and inflation. And that's good for real estate. It means that there's more people looking to occupy real estate, so demand and occupancy increases. Higher inflation is also good for rents. So, your buildings are more full and landlords have more pricing power. And then the second reason why higher long-term bond yields do not coincide with declining real estate values is because credit spreads actually decline. As the economy improves, what happens is lenders become more confident, they become more competitive in offering loans, and so credit spreads actually shrink, which offsets much of the increase you see in the underlying base rate. So in a nutshell, for those who are worried about interest rates, the Fed's less important than the long-term rate of interest rates, and that by itself is only one relatively small ingredient in the overall pricing dynamic for real estate values. If there's one thing to care about, if you're going to think about investing in real estate today, be it REITs or private real estate, it's the direction of the economy. If the economy is going to improve, real estate's a good investment. If you're worried about the economy, it won't be a good investment.
So why do you think there's this misconception out there that, where people believe rising rates are bad for the real estate sector? Do you think people just lump them in with other high yielding segments like utilities and staples?
I think it's because it's complex. I mean, I've been doing this for 20 years, and certainly for the first 10 or even 15 years of that, wasn't as clear to me either. So, I think it's because it's not simple. It's complex. And, at the end of the day, professional investors like ourselves look for periods where, people are selling REITs and real estate for the wrong reason to take advantage of those opportunities. I mean, for instance, at the beginning of the year, we basically came out and said, look, REITs are screening very cheap right now because there's a lot of people out there who are worried about higher interest rates. They shouldn't be. What's going to be more dominant is the economy, and the economy's in great shape. And as a consequence, REITs have done pretty well so far year to date. They're up 5%, keeping in line with the S&P 500. So it's a rule of thumb that is correct in the very, very short term that higher interest rates are bad for REITs, but it's a rule of thumb that consistently does not work over a more medium-term horizon.
So what are some of the various REIT subsectors that might either be winners and losers in this sort of environment? Are you seeing any, be it like data centers or retail? Are there any that are well positioned to take advantage of the current market environment?
Well, it's a very good question because even though real estate overall remains a very good investment as interest rates increase, it does change the way in which you want to allocate to different types of real estate. Very simplistically, you want to avoid those kind of real estate that are types that are more bond-like and allocate towards real estate types that have shorter lease durations to capture the benefit of economic growth as the economy improves. So, avoid long-term leases, avoid net lease, allocate towards office, allocate towards apartments, allocate towards hotels, and also allocate more of your capital towards development. You want to develop into an improving economy. That's the most direct way to take advantage of improving demand and improving rents. As that relates to different subsectors right now, you need to overlay that with what's happening at a more micro level in terms of real estate supply and demand. And the big things to care about right now as a real estate investor has to do with urbanization and has to do with technology. It's essentially, real estate is valuable to us because it serves a purpose in how we live and work. And as how we live and work has evolved pretty dramatically post the financial crisis, so too has the relative value of different types of real estate. The kind of real estate to avoid right now is retail, particularly low quality retail, because that is fast becoming obsolescent due to e-commerce. And not just e-commerce, but also the way that we spend our free time and socialize. And a lot of that has to do with the fact people spend more time on their phone than at the mall. People don't need to go to the mall or the local shopping centre to buy an item. They can do that through their phone. But that being said, out of the 1,000 malls in this country, the top 200 malls are extremely valuable, some of the most valuable real estate assets in the United States. And that's because not only are they very profitable for the underlying tenant, but they also serve a marketing purpose. So you have this bifurcation of retail going on. The other area that is being negatively disrupted right now by social change and regulation is the healthcare space. And essentially, whether it's repeal the Affordable Care Act or other measures such as Medicare Advantage, what's happening is we're trying to put a lid on spending growth as it relates to healthcare. The fact is we spend the most per person in the United States as it relates to healthcare spending, yet have, rank outside of the top 30 in terms of outcomes according to the World Health Organization. And so what that means is as we re-engineer the healthcare subsidy model, particularly as we move away from subsidizing costs to basically paying for outcomes versus tax credits, dollars will shift, and they're going to shift away from skilled nursing, they're going to shift away from hospitals, they're going to shift towards medical office buildings, which offer more of an outpatient a la carte approach to healthcare provision. Now, on the other side is where change that we're seeing in the world is unequivocally positive for real estate, there are a number of asset classes. Data centers is one that you mentioned. The amount of data we consume is incredible. It's going to increase exponentially. One driverless car consumes 100,000 times the amount of data as one individual. So as we move forward through time, our needs for data is going to increase exponentially, and the need for data centers and other physical infrastructure that enables that virtual economy is also going to increase exponentially. The other area that's very, very hot right now, is going to stay hot, is creative office, particularly in cities like San Fran, New York. We really have to re-engineer the office environment away from one that was built to process information toward one that is built to enhance collaboration and discussion of information and analysis. And last but not least, industrial warehouse distribution. It's the backbone of e-commerce. It's the physical infrastructure that allows e-commerce to exist, particularly as it relates to retail. It is the other side of the demise of the low-quality mall, is the fact that Amazon needs a warehouse somewhere so they can get that little brown box to your doorstep. And that's driving incredible demand for a re-engineering of our supply chain, which is being taken advantage of by a lot of real estate REITs out there that are helping to build those warehouses that facilitate the new economy.
Yeah, it definitely sounds like there's a lot happening in the real estate market that a lot of investors probably weren't aware of until just now. Let's switch gears a little bit and talk about some of the funds that you're looking to use to take advantage of these changing trends. First up, we got MRESX, and that's a U.S.-focused REIT fund. Maybe you can tell a little bit about the process that goes behind selecting securities for this product.
So, we have a dedicated team, a global team based here in the U.S., also offices in Europe and Asia. And we spend all of our time out there in the field, visiting markets, seeing what's happening in terms of real estate fundamentals, spending a lot of time with management, understanding their strategy, and then spending a lot of time figuring out what the value of their real estate portfolio is and arbitraging price deviations between how Wall Street's valuing property versus, how Main Street or the underlying property market is valuing real estate. And so when we see these big deviations, the stock market, for some irrational reason, is pricing a real estate portfolio very cheap, that's where we make an investment. And as the market recognizes the value of that portfolio, we'll sell our investment and go do that again somewhere else. So we're looking at about 300 companies around the world, about half of those that are in the United States. We're doing our own underwriting analysis. It involves a lot of field work. We do over 300 property tours and management meetings a year in the U.S. alone to get very granular in terms of what the underlying value of the real estate portfolio is so that we can find those pricing anomalies. And that's how we add value for our investors.
Yeah, there's also a global real estate securities fund, DRLIX. Maybe you can talk a little bit about some of the countries in particular that you're focused in on. It looks like a lot of developed markets. Are you seeing anyone stand out in terms of being a good value these days?
So that's a developed market strategy, as you pointed out. It has a global mandate and a global focus, which means that roughly about 50% of the investments are outside of the United States, primarily in Europe and the UK, Japan, Hong Kong, Singapore, and Australia. I think the best opportunities right now internationally are probably in the United Kingdom. Property companies there have sold off 20% since the announcement of Brexit. On top of that, you have the pound down another 15%. And so you've had in US dollar terms, a 35% decline in REIT prices in the UK. The bottom line is the underlying physical property markets have not really changed at all. They've held very firm. And one of the reasons for that is that UK gilts or UK interest rates have fallen pretty significantly. So it appears to us that the market is irrationally fearful about some kind of precipitous decline in UK commercial real estate values. We see that as an opportunity. We can look at the European crisis of 2011, which, I think was frankly much more of a fundamental concern to the UK and Europe as some kind of guidepost. in that time period, we did see a softening in real estate values in the UK, but it was more in the order of 3 to 5%. And so right now, we're pricing in a 15%, 20% decline in commercial real estate values, which we just think is ludicrous, but at the same time offers a very compelling investment opportunity.
So are you looking at the same sectors in some of these foreign markets that you are in the U.S., or is there kind of a different profile of exposure that comes into investing in Japan or the UK or Australia?
Well, most people are used to hearing about the main food groups, if you will, office, retail, industrial, hotel, residential, apartments. But what's very interesting about the listed real estate market globally is this growth of the niche sector that people might not be aware of, and it's harder to get access through other types of investment away from the REIT sector. And they include asset types such as student housing, asset types such as self-storage, asset types such as single-family housing rental, and data centers, which we've also spoken about. And so one of the most interesting parts of the real estate market globally, and this applies to most countries even outside of the UK, is access to these niche property sectors where not only are you getting access to real estate, but you're getting access to a management team and platform that has a real competitive advantage of investing and operating real estate assets in an asset class that has not been institutionalized yet. And so what that means is they can come in, they have a better acquisition and disposition discipline, they have a better operating discipline, they have better access to capital, and what that means is they're really able to grow their market share in a profitable way in these niche sectors. And that's a very exciting part of the real estate market here in the US, and also many markets outside of the US that you can't really get access to outside of the REIT market, where we're spending a lot of our time today.
Yeah. Are there enough companies in some of these smaller subsectors like student housing or data centers? Obviously, there's not as much as there is in, say, the broader retail world or office space, but it just seems like it might almost be too small for investing purposes. Are we seeing a big surge in the number of securities that are focusing in on these more niche sectors?
Yeah, there's been a significant surge following the financial crisis. And if I look at the US market today, by way of example, it represents almost a third of the entire US REIT market. I think, storage, data centers, student housing, etc., single-family rentals. In other markets, the other markets are lagging the US, but they're certainly experiencing very high levels of growth. So if I look at the United Kingdom, for example, that's a market where these non-traditional sectors are probably closer to 10% of the REIT market in the United Kingdom. The fact is, this is the fastest growing segment of our investment universe, and so it's only a matter of time where until these gravitate towards a very healthy portion of the underlying REIT market like we have in the United States.
Okay, Scott, great to have your perspective on the REIT world and this interesting time for the sector. Thanks for coming on.
Thanks for having me.
Okay, everyone, that was Scott Crow of Center Square. You can check out his funds at centersquare.com, and the tickers for the funds are DRLIX and MRESX, while the performance information we discussed was as of mid-March 2017. Well, hope you enjoyed this edition of the Dutram Report, and make sure to tune in next week for another discussion on the world of investing. But until then, make sure to find us on social media or subscribe and give us a good review over on iTunes if you've been liking this podcast. For Zacks.com, this is Eric Dutram signing off. Have a great weekend.